This is why you're still broke. Welcome to the foundation. I mean no disrespect at all. But these are things that are true. There is information that we don't know. That there's things that we don't know. There's things that we don't know that we don't know. And if you don't know something, and if you don't know that you don't know something, how can you know to learn it? I know that kind of gets in the weeds, but I'm going to share some concepts that might be a little foreign and difficult to grasp, but I'm speaking specifically with regards to why you're still broke. I know I did the last episode. This is why you're broke. I'm going to kind of go to a different area. And if you're paying attention, there's going to be things that I'm saying that I'm not going to say, if you understand what I'm saying. So maybe check this episode out a couple different times, 3 times, 4 times, maybe even 7, but I'm going to go there. So officially, I would like to welcome you to the foundation where we understand incorrect information incorrectly applied can get you hurt. Correct information incorrectly applied can get you hurt. So as always, we are correctly applying correct information here at the foundation. My name is Sot L, seeker of truth L, speaker of truth L, SOT, and it is my absolute pleasure to be here with you on another glorious Wednesday, Mercury day. So let's jump into this show. I do not want to take up too much of your time. I've been working on getting getting the shows a little reduced when it comes to the time. But I do want to say this, I think one of the main things as far as people not feeling financially as secure or free as they want to has to do with, most people are just looking to get money for themselves and for what they want. And that's a very limiting scenario. And, when we start talking about family, especially when we start talking about multiple generations, it allows for more of a broad and more of an encompassing, I would say, result. How about that? A result. Saying things without saying them. This is the episode. I'm going to say that again. Saying things without saying them. But if you're just out for what you can do for yourself, just probably, the foundation isn't really worth your time. I would definitely say that. No disrespect, with all due respect. It's not for everyone. So let's jump into this show as we normally do. Please make sure to check out welcome to thefoundation.com. Sign up for the email list at the very least. We have some amazing things happening. I don't know. I'm just really excited. I'm just really excited to teach this information to people. That's what I'm excited for. I'm excited if you guys don't hear that airplane that's in the background. But seriously, being able to teach this stuff to people, it's not an immediate gratification type thing. Most people are used to immediate gratification. That's not what the foundation is. That's not what trust administration is. Definitely not. It's a thing that you build on, and as you build, more and more benefits accrue. I like that word, accrue. But what I really want to talk about today is something really, near and dear and special to me, because these are things that I personally have benefited from. My family has benefited from. And that's where the excitement comes for me. I don't know. It's like, I can't do it again. But, when clients or trustees, when they do it, I kind of get that feeling again. But nonetheless, let's get into this episode. As always, I want to touch on silver. Ooh. Silver is currently at $63.25. It has dropped below the 200-day moving average. That's wild to me. If it doesn't bounce, which I'm usually, stuff does, but I don't know. It's a buying opportunity. How about that? Dollar cost average, $25, $50, $100 every 2 weeks, every month. Go grab some silver, fractional silver, all types of stuff. You will thank yourself in the future. You will think back and thank your past self. So right now, take care of your future self. Dollar cost average. Go grab silver. It's it's low. It's a buy. It's a buy. Hold on. Oh, it's a sell. I'm saying it's a buy, especially the physical. What we have here, the Shanghai silver price today specifically, $71.39 in the Eastern spot price. The Western spot is $63.24. That's it's a difference. The spread, I would say, is converging a little, but it will never be an equal price between the Eastern spot price and the Western spot price ever again. That's important, but let's jump into this. This is why you're still broke. Trust tax rates 2026, how trusts are taxed and when it becomes a problem. This is a law firm. You can check them out. I just like the information that they put out just because I think it adds more validity to what we speak here or speak upon here at the foundation with regards to trust administration. There's a lot of information available in the public that can assist you with narrowing down what we do here at the foundation and how it's distinct and separate, contradistinction to, what we call public trust or state statutory trust, so on and so forth. So let's jump into it. And this is what turns people off. It turns people off. 37% federal income tax rate applies to trust taxable income above $15,650. Add the 3.8% net investment income tax under the Internal Revenue Code, subsection 1411, and retained investment income in a non-grantor trust can face a combined federal rate of 40.8%. This is before California's 13.3% top rate applies on top of that. So I'm sure this law firm is in California. Once again, private trusts do not file state returns. So this part, the California part, is irrelevant for what we're talking about. But let's jump. So trust taxable income 2026 federal rate from 0 to $3,150. So $3,150, 10%. Anything over $15,650, 37%. For comparison, a single individual reaches the 37% bracket only at $609,350 of taxable income. A married couple must bring in $731,200. A trust hits 37% at $15,650. How trust income is taxed from 1041 and the DNI framework. DNI is a distributable net income. Oh yeah, it says it down here. A trust files 1041. Yep. On that return, the trust reports all income it received, interest, dividends, rents, royalties, capital gains, and ordinary business income, and then claims a deduction for the portion distributed or required to be distributed to beneficiaries. Under Internal Revenue Code, subsection 643, distributable net income serves two purposes simultaneously. First, it is the maximum amount the trust can deduct for distributions to beneficiaries. Second, it is the maximum amount of those distributions that is taxable income to the beneficiary. DNI prevents both an unlimited deduction by the trust and unlimited inclusion by the beneficiary from exceeding what the trust actually earned, right? Okay, net investment income, right? Simple trust versus complex trust. We're just gonna get here. Let's just do it because I just think. So a simple trust must, under its governing document, distribute all current income to beneficiaries each year. It cannot make charitable contributions. It cannot make charitable contributions and cannot distribute corpus, which is, body of the trust, because it distributes everything. The trust pays little or no income tax itself. The income passes through to beneficiaries at their individual rates. The trust claims a $300 personal exemption on Form 1041. Okay, a complex trust. A complex trust. I'm saying things without saying it. It does not meet the simple trust requirements. Okay, that's great. It may have discretionary distribution authority. Discretion? You know what discretion means? Discretionary? You should look that up. Accumulate income, distribute principal, or make charitable contributions. Make charitable contributions. Make charitable constitutions. I'm sorry, contributions. Constitutions too, why not? These features give the trustee flexibility, but income the trustee chooses not to distribute is taxed in the trust at trust rates. The complex trust personal exemption is only $100, but but income the trustee chooses not to distribute is taxed. And I would just say, it takes allowable expenses as well. It takes allowable expenses as well. This distinction matters most when the trustee has discretion. A trustee of a complex trust who accumulates income thinking they are, quote, protecting, end quote, assets may be creating a significant tax cost. That income gets taxed at 37% in the trust rather than at whatever lower rate the beneficiaries would pay individually. In many cases, making the distribution and letting the beneficiary pay tax on their own rate produces a better after-tax outcome. I mean, that's if, the distributions are to individuals. That's if the distributions are to individuals. That's if the individuals are distributed to. Let me move forward. Check this out. This is Tax Shark. Can a trust deduct charitable contributions? Plus facts. Oh my goodness. Can a trust deduct charitable contributions? Yes. And you're like, so what? Why do you keep? Because you're saying, we hear you saying charitable deductions and charitable contributions. We hear what you're saying. Why? Why are you saying this? I'm saying it without saying it. Pay attention though. In 2024, a trust hits the top 37% tax rate with just about 1,500. I think it's 15,000 or 15,000. I think it's 15,650 if I remember correctly. I don't know. Doesn't matter because never have to deal with that because, we administer complex trust. Exact IRS rules. This is a chat GPT, obviously. This is chat GPT, right? The quick answer is yes. The question is, can a trust deduct charitable contributions? Quick answer, yes. Under U.S. federal law, a trust, as a separate taxpayer, may take an income tax deduction for donations to qualified charities if it meets two primary requirements set by the Internal Revenue Code. One, it must be paid from trust income. The contribution must be made from the trust's gross income or taxable income, not from the original principal or corpus. Right? Makes sense? Two, it must be authorized by the trust document or the trust governing instrument. When these conditions are satisfied, a non-grantor trust can deduct charitable payments on its Form 1041 federal return just like an individual would on a 1040, but with different limitations and perks. Notably, qualifying trust donations are not capped by percentage of income limits that apply to individuals. Qualifying trust donations are not capped by percentage of income limits that apply to individuals. That is 50% adjusted gross income can be donated and receive a charitable deduction with regards to an individual to a public charity, and only 30% with regards to a private charity. This is AGI, adjusted gross income. I'm not a lawyer. I'm not a tax advisor. I don't have a bar card. I did not pass the bar exam. I don't know what you're talking about. I could be crazy sitting here in my underwear with, Jell-O pudding pops sitting all around me. You know what I'm saying? Listen, that's my disclaimer. But 50% public charities, 30% Private charities. Mm-hmm. Qualifying trust donations are not capped by percentage of income limits that apply to individuals. A trust can theoretically deduct up to 100% of its taxable income for amounts paid to charity, potentially reducing its taxable income to zero. Oh my goodness, what? This isn't the foundation saying this, you know. I think it carries more weight when Sot L doesn't say it, unfortunately. It's cool. I have no emotional feelings about it. My thing is, you know, the object. And the object is for people to get this information. That's the object. Ain't no celebrity in this dance. As long as you get it, I'm happy. Let's high five and let's know our dance. But yeah, a trust can theoretically deduct up to 100% of its taxable income for amounts paid to charity. A complex trust, non-grantor complex trust, can deduct 100% of its taxable income for amounts dispersed to beneficiaries. We saw that. We saw that in the other article. Okay, there's 2 points. 2 points right there. Dispersed to beneficiaries. But they were talking about individuals. We don't talk about individuals. That was a question. Why would you do that? Why would you do that? And then 2, charitable deductions. The charitable contribution must be to a qualified charity, generally an organization described in the Internal Revenue Code subsection 170C, such as a 501c3 public charity or, oh my goodness, what is this? Oh, wow. Private foundation. I'm in a good mood today, y'all. So excuse me. Private foundation. Unlike individuals, trusts may even deduct donations to certain foreign charities or purposes, but it must still serve charitable objectives as defined by tax law. Bottom line, a trust can deduct charitable contributions at the federal level if it's the right type of trust and follows the Internal Revenue Code subsection 642C. Rules, common mistakes, lacking trust authorization. It must be in the indenture that it can make donations to charities, donating principal assets. And can't do that. Treating grantor trust the same as non-grantor trust. Can't do it. It's a mistake to assume all trusts get a deduction. It's a mistake. If the trust is a grantor trust, tax to the grantor, the trust itself cannot take a deduction on Form 1041. Any charitable gift from a grantor trust is treated as if the grantor made it personally. Failing to recognize this can lead to missed deductions if the grantor doesn't itemize or deduction limits that the trustee didn't anticipate, since the grantor's personal AGI limits apply. See? Adjusted gross income. But what do I know? Like I said, pudding pops. Don't listen to me. Missing deadlines, poor substantiation in reporting. Poor substantiation. That's bad. That's bad administration. We don't teach that here in trustee training. Overlooking state tax nuances. And this, this does not apply if the trust is not governed or crafted by the state or any of its agents, i.e. bar attorneys. They all have state bar cards. Their cards come from the state bar. Don't believe me? Ask them. They got some case examples. I want to get into this. Philanthropic planning, charitable trust versus private foundations. I'm going somewhere. Where's he going? Charitable trusts and private foundations offer different levels of control and involvement in philanthropic giving. Charitable trusts are irrevocable and provide significant tax benefits, but offer less flexibility. Private foundations offer greater control and flexibility, but involve more administrative oversight and costs. So you say. Let's go to the charitable trust. We don't care about that. Where was that? Main differences between charitable trust and private foundations. Charitable trusts are governed by trust law with oversight from state courts. Don't want that. Private foundations and nonprofit entities are regulated by the Internal Revenue Service with stricter reporting requirements and rules such as the 5% minimum annual distribution. Okay, 5% though. I mean, oh my God, that'll be difficult. Funding and financial oversight, deciding factors. navigating tax considerations. Listen, but here. Control and flexibility. Charitable trusts offer tax benefits and asset protection, but limited flexibility after formation. Private foundations provide greater control, allowing donors to adjust giving strategies over time and involving future generations. Remember when I said earlier, if you're just thinking about yourself and your happiness, your wealth, you're going to be limited in ability, in my opinion. If you're thinking about your family and your next generations, future generations, it's an expansive platform and, force and power that you draw from. But you must be sincere. Oh, loans, lending money or extensions of credit. This is charities and nonprofits. You see this? Charities, nonprofits. I'm under private foundations. Lending money or other extensions of credit between a private foundation and a disqualified person is an act of self-dealing. A disqualified person would be a trustee for sure. However, this does not include lending money by a disqualified person to a private foundation without interest or other charge if the borrower uses the loan proceeds exclusively for purposes specified in Section 501c3 of the Code. For these purposes, a loan by a disqualified person to a private foundation at below market interest rate is treated as an act of self-dealing to the same extent as a loan at market interest rates. Okay, so we never loan the foundation money. What's the problem? I mean, listen, and why would you as a trustee take a loan from the foundation? That's self-dealing. The IRS says that. An act of self-dealing occurs when a third party buys property and assumes a mortgage held by a private foundation. And a third party transfers the property to a disqualified person who either assumes liability under the mortgage or takes the property subject to the mortgage. Making a promise, pledge, or similar arrangement regarding money or property to a private foundation by a disqualified person, whether by an oral or written agreement, a promissory note, or other instrument of indebtedness, is not an extension of credit before the date of maturity to the extent that it is motivated by charitable intent and is unsupported by consideration. Okay. But here's what I want to point out right here. Lending money or other extensions of credit between a private foundation and a disqualified person is an act of self-dealing. However, this does not include lending money by a disqualified person to a private foundation. So this would assume, right, through, I would say, deductive reasoning, but through simple logic, that foundations can lend money to qualified persons. If there's a disqualified person, then there are qualified persons, and persons are individuals, corporations, trusts, partnerships, so on and so forth, right? So the disqualified person would obviously be a trustee. This is a tax-exempt 501c3 entity, right? But this, we'll call it a structure. The private foundation or private family foundation can lend money. And because it's tax exempt, it generates income off the interest from those loans tax-free. So a qualified person is any LLC, trust, or corporation. And I would go so far as to say a disqualified person would be any person, and I'm talking about individual, corporation, LLC, trust, partnership, etc. If any person is making charitable donations and receiving deductions on its taxes, that person should not be taking loans from a private foundation, from the private foundation where it is making donations. I would say that would disqualify that person. It doesn't say that in Internal Revenue Service. I just think it's good administration. But an LLC, an LLC, a business trust, a trust could definitely take a loan from a private foundation at interest, and that LLC or partnership or trust will pay no taxes on that loan because the loan is not income. And generally, corporations, LLCs can write off the interest they pay on loans. I know this is kind of heavy, but just check me out, right? So I'm going to say something without saying it. I'm going to say something without saying it. How whole life insurance cash value works. Oh, did you know? This is what they call private banking, whole life insurance. Does more than just pay a death benefit. It builds a living financial asset called cash value, which grows inside your policy on a tax-deferred basis for as long as you keep the coverage. Do all whole life insurance policies build cash value? Yes. Term life insurance doesn't build cash value at all, which is one of the main reasons whole life costs more. Some policy types like modified whole life build cash value more slowly in the early years, but every permanent whole life policy builds it eventually. How does whole life insurance build cash value? Whole life insurance builds cash value through a guaranteed growth rate set by your insurer. At the time you purchase the policy, the rate is fixed, meaning your cash value account grows steadily regardless of stock market performance. Regardless of stock market performance. Guaranteed contractual growth of cash value regardless of stock market performance. Some whole life policies for mutual insurance, there you go, mutual insurance companies also earn dividends. These are the ones you want, y'all. You can put those dividends directly into your cash value to grow it faster. The guaranteed rate is modest compared to the market investments, but it won't drop during downturns. That stability matters if you're using a whole life policy as part of a larger financial plan. Okay, so I'm going to say something without saying it, y'all. And how do I do that? I thought about this for a while. So here's what I'm going to say, but hopefully you can hear what I'm not saying. Businesses can take loans from private family foundations as long as they are not disqualified persons. So can business trusts. Generally, when you're dealing with a private estate, the family trust is the owner of the life insurance policy. You will also find that the private family foundation is the owner of policies as well. These policies earn cash value. In the wealthy families, everyone has life insurance on them. These whole life cash building, cash value, interest earning, regardless of market rate, and market conditions, everyone has them. So when you hear like, oh, I'm a trust fund, baby, I get my money at 18 to 21, they're getting the cash value of their life insurance policy. And every time everyone dies or passes away, there is a death benefit check that is set to the family trust or the family foundation. This is how the wealthy get wealthier. This is what I'm doing right now, man. I'm not playing around. I'm already over here. So, your business can make money. It's important to have a business, and that business, of course, can be owned by, substantially 100%, or substantively by a private trust. Profits, and private trust, complex trust can disperse 100% of their taxable income to their beneficiaries if the beneficiary is correct and you know how to set up the proper estate. The thing about this is that you walk away, you start a business. It could be a modest business that makes $10,000 a year. That's all you need. Because with the right premiums paid to a life insurance policy, you do not understand what happens. You don't. And we're talking about loans for cars. We're talking about loans to start businesses. This is to your family members, of course, at market rate, but with very, 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 very loose terms as far as like when repayment is due, so on and so forth. And that's not illegal. And the interest, goes back to the family trust or to the family foundation, preferably, as well as the loan payments. And, these payments are used to pay premiums or pay cash value loans with gross policies. Okay, so I'm gonna read this down here, right? And I'm just gonna say this is conservative, this is conservative, this is conservative. How much cash value does whole life insurance build? The cash value a whole life policy builds depends on the coverage amount, your age at purchase, premium size, and your insurer's guaranteed growth rate. A 35-year-old with a $500,000 whole life policy might accumulate $50,000 to $75,000 in cash value after 15 years. That's conservative. And the $500,000, that's $500,000. That's the death benefit. So it's not like, oh, you came up and you threw them $500,000, and they no. You get the life insurance policy. You pay the first premium, which is a couple $100, And then the death benefit is, $500,000, $250,000, $300,000, $600,000, depends on how much you're paying into the premiums. But you set it up. And depending on how it's set up, $50,000 to $75,000, then they said 15 years. You could say 7 years. You can say 6 years. You can say 5 years. You can even say 10 years. And you can, all of those ranges work. And this is just paying the premium. It's a private bank. And when you set it up privately with private trust, and especially with a private family foundation, it changes everything with regards to your family's economics. It takes some time. It takes a year, 2 years, sometimes 3 years for the cash value to build, depending on how you set it up. But trust, a complex trust can disperse 100% of its taxable income and therefore owe no taxes. So just with the proper distributions, my mentor always said, I don't care how much money you made, how much money did you keep? And that's what I say now, because it's real. And that's what trust administration is about. Is we don't care how much you make. How much did you keep? And the year before. And the year before, how much did you keep? And the year before that. And the year before that. Okay, so how much do you want to keep next year? And the year after that. And the year after that. And the year after that. Because you get to decide. The years previous, you didn't get to decide. And y'all know me. I'm Sodell. I've been doing this for over 10 years. Publicly. Blog talk, radio, which it doesn't even exist anymore, to YouTube. Over 10 years. And this is what I'm saying without saying. This is what I'm saying. This is why you're still broke. Right here. Because you don't understand this. Remember what I said? There's things that you don't know. This, what I just said in this show, this episode of The Foundation, I believe is what a lot of people don't know. They don't know. And of course you need guidance. Of course you need education. Of course you need to invest your energy and focus to get to a point to be able to take advantage of this. But listen, we're talking what? 3 months? 6 months? And is that worth it to change the rest of your life? To go somewhere you've never gone, you must do things you've never done. Even if it's, go down a street that you never went down, read a book you never read, write with a pen you never wrote with. You got to do things you've never done to go where you've never gone. I know that from personal experience. So, I trust you understand what I just put down. At the very least, sign up for the email list. We'll get you right. You click this key over here on the left-hand panel. Let's go back. This is the menu right here. You hit this and it'll come out. The little 3 bars. If you hit the 3 bars, the menu will come out. It'll pop out. It's Trustee Training. We have silver, gold, and platinum. And what I'm doing right now, and what we're doing right now, is anyone who signs up for the platinum, you also get access to the weekly live calls every Sunday at 5 p.m. Eastern, 4 p.m. Central, 2 p.m. Pacific. Every single Sunday, it's live. I do a live training every single Sunday. And how we do it is, we'll go in sessions, and once we finish the first, the whole session, we just start over. And you can stay in as long as you want. It's completely up to you. That's how we've set this up. So silver, gold, but platinum right now. I just recently started up the weekly trainings. With me, I call in, you call in, we all call in. We all got our materials, we got our manual, and we do our dance. And we have question and answer at the end. We answer all your questions. Any questions you got. And that's good for, everyone else, because, there may be a question that I didn't even think about asking that you asked, and now I got value. So yeah, we have the weekly calls back up. That's right now we're letting people who sign up for the platinum to do that. So if you're interested, otherwise we have silver and gold, and each one of these tiers that you sign up for, whether it's silver, gold, or platinum, you get a complimentary 60-minute consultation with me. So we can get specific about what you're doing, what you're looking to do, what you want to do, and how we can, begin to assist you to do your dance. Because that's the main thing. So, this is why you're still broke, y'all. You don't know what you don't know. And, we're here to get you right here at the foundation. Leave a comment. You got a complaint. You think I'm lying. You want to say peace. But outside of that, I trust you learned something. But there it is. Y'all are